In this segment, we're going to talk a little bit about two particular types of investments that you need to be very careful with, particularly as a result of their internal cost and their tendency to be very leveraged. And what that means is they borrow money to sort of amp or juice up the return, or to be very sector specific. So the first category that we're going to kind of talk about in this segment is this notion of hedge funds. And the second, in fact, is ETFs, which many people assume are some of the most cost-effective types of investments. But according to Morningstar, at least, that might not actually be the case. A lot of ETFs may actually be more destructive of value than constructive of value, at least based on the most recent research by the folks at Morningstar. So we're going to start with the hedge fund side of things, which clearly have exploded in assets over the course of the past 25 years. In the year 2000, there was about $200 billion that was held in hedge funds. Today, that number is $6 trillion. So big increase in the amount of assets that are held in hedge funds. Where you see it particularly having grown is inside of institutional money. So things like pension plans and the like, those are where more of those dollars are coming from to feed into these hedge funds. In fact, 7% of all public pension funds are invested in hedge funds. So things like the state of Florida retirement system, things like that, those would be the types of plans that would have a significant portion of money invested in hedge funds. And then large endowments as well. Almost 20% of those assets are held in those types of hedge funds. And I suppose it's sort of the cachet of owning a hedge fund, right? And I own a hedge fund, and that because the hedge fund world was always sort of reserved for the super elite and wealthy, and that was how they were investing their money. Problem is that most hedge funds don't necessarily have the kind of returns as what they used to, simply because it's much harder to find those needles in the haystack these days, especially with the massive flow of information. And certainly based on the most recent research, and this was published in the Wall Street Journal earlier this year, over the course of the past 2 decades, fees in hedge funds have amounted to more than 50% of gross gains. In other words, over that period of time, according to research by the Wall Street Journal, hedge funds earned about $3.7 trillion for their investors, but kept nearly $1.8 trillion of that $3.7 trillion in the form of fees. The worsening of those fees to gains represents how hedge fund returns have in fact moderated in recent years, simply because it's harder to find those more unique opportunities, especially with the speed with which information flows these days. So what you're seeing in the hedge fund world is the returns aren't as good as they used to be, just generally across the board. But unfortunately, even though the returns aren't as good as they used to be, there hasn't been any reduction in fees, and in many cases, the fees have actually crept higher. Many hedge fund firms take a management fee of 2%, plus a 2% per year, plus a performance fee of 20% of fund profits. That's right, 2% per year plus 20% of fund profits. Some places charge even more than that. As you might well imagine, that's sort of a significant drag on performance. And what was funny about the research is that it's nearly identical to my personal experience with owning this type of investment. And we've certainly shared the results in prior shows of that. Where that comes from is one of the sort of the fundamental tenets at Nelson Financial Planning is that our clients don't own anything that we don't have our own personal money in. So what that means is that from time to time, as products evolve and become more available to the masses, like these things like hedge funds, for example, then we feel it incumbent, in order to make sure that we're providing the best possible investment recommendations to our clients, to actually take and put some of our own personal money at risk to really get a better understanding of exactly how this stuff works. Because let's face it, folks, when you do it with your own money, you pay a little bit more attention. And so that's something that we've always done, and certainly we would say that we want to be learning with our money and not our clients' money, which I guess should be kind of appealing to everybody, right? You don't want me to really learn with your money, so to speak. So this was probably 10 years ago. Invested about 50 grand in one of these, not about, it was exactly 50,000 because that was sort of the minimum investment, and into one of these kind of hedge fund-like types of investments, and certainly shared the results of how all of that went on prior programs. But when the fund closed out, which now is like probably a couple of years ago now, and at the end of the day, our actual return over that holding period wound up being less than 5%. And what was always confusing is that on the marketing papers, or in the final report that I got, it said, well, the IRR, okay, which stands for internal rate of return, was 9%. That internal rate of return doesn't mean anything because that's like the gross return. The net return is what you get. It's almost the same kind of thing as what we were talking about here a couple weeks ago in terms of how the annuity people kind of manipulate the numbers to make it seem like you're getting a better return when you're really not. Because in the annuity case, they count the original investment coming back to you as part of your quote-unquote return, and at the end of the day, that's not really your return when you're getting your own money back. The reality is that it's kind of the same thing in the hedge fund world, except I guess it's slightly different, where they talk about the IRR, the internal rate of return, but the internal rate of return doesn't mean anything to you because you're not internal, you're external. They're the one that's going to get the net return, and ultimately that's the piece that ultimately matters. And at the end of the day, much like my personal experience, nearly matched exactly what the Wall Street Journal research had done, because in fact the fees did in fact consume half of the return, which means that you're not getting nearly what you thought. So if you have a hedge fund or hedge fund like type of investment in your portfolio, be very careful. It may be typically described as an alternative investment. Those have become, that category of investments has become all the rage when people say, oh, you need to have an alternative part of your portfolio. At the end of the day, it might not be adding a whole heck of a lot. Talking about a couple of the investments out there that you probably want to be very careful with in your portfolio. What we were talking about before the break is this notion of these hedge funds, often considered sort of alternative investments, get pitched a lot about them as, oh, you need this in order to expand out the diversification of your portfolio. And that's fine, and I'm not saying that your portfolio should be diversified, but sometimes the concept of diversification can also come into play, because if you have these types of alternative investments and you just have them in the portfolio because they're different than what you have, the reality is, though, that the question that you have to ask is, well, what value is said diversification actually going to bring to the table? And the example of these types of investments, these hedge funds types of investments, these alternative investments, as we were talking about before the break, the fees typically will consume half of the return. That was certainly our personal experience when we chose to sort of do a educational exercise to see how those things worked with our own personal money about a decade ago, which finally closed out here, like we said, about 2 or 3 years ago. The IRR that was advertised through all of the promotional materials right to the very bitter end was this was a 9%er, okay? Yeah, not exactly. It was not a 9%er. The reality is that it wound up being half of that because the institution took half of it in the form of fees, which basically, as we said in the prior segment, mirrors the research out of the Wall Street Journal, which concludes that the hedge fund industry as a whole about half of the return that is generated for its clients got consumed up in the form of fees and expenses. So be careful with that. And then also saw this analysis from the folks at Morningstar naming the funds with the worst performance record in terms of dollars over that past decade. This was a recent research report by the folks at Morningstar. It came out at the end of April, naming the 15 worst performing funds. What was surprising, if you will, about that list is of the 15 worst performing funds, 13 of them were ETFs, or exchange traded funds, which have become very, very popular over the course of the past decade in the industry. The reality is that a lot of exchange traded funds out there can be highly leveraged, which means they're borrowing money to sort of juice up the return, or they can be very highly sector specific as well. That can be a very potent combination for you to potentially lose a bunch of money. And as the Morningstar list shows, and even Morningstar commented, certainly provided a valuable case study in how not to invest. So bottom line, don't necessarily be fooled by the use of ETFs inside of your portfolio. Oh, right, they're low expense, blah, blah, blah. But it depends on the type of ETF that you have. They can certainly do a lot of value destruction as well, rather than value creation. So interesting stuff. I guess at the end of the day, it always comes back to something that we've always said for years and years and years on this program, which is know what you own. Okay, know the nature of it, what it is, what it's there for, how it actually works, what's it bringing to the table, what the underlying costs are, all of that. Pretty important stuff when it comes to knowing your investments. So some interesting latest research, if you will, on that area.